Look, we all know these stock images and clips are straight out of the bargain bin. Whiteboards that look like they were drawn by a caffeinated intern, graphs that might as well be doodles from a napkins, and videos where the dynamic trading is just some guy staring at a screen like it's his ex's Instagram. We're not Hollywood here. We're just a couple of crypto nerds piecing this together with free assets and a dream. But hey, stick around because the breakdown on trading volume trends is actually gold. Stuff that'll make you smarter about the market without the fluff. This isn't financial advice, folks, purely educational and for entertainment. Crypto's volatile as heck, so do your own research and maybe chat with a pro before you YOLO your savings. Ever wonder why some days the crypto market feels like a ghost town and others it's a total frenzy? Like Bitcoin's chilling, but suddenly Ethereum's volume explodes and steals the show. That's the wild world of trading volume trends we're diving into today. Because understanding this can turn you from a casual hodler into someone who spots the real momentum before it hits. Let's start with the basics, because if you're new to this, trading volume is basically the heartbeat of the crypto market. Imagine volume as the total amount of a cryptocurrency that's bought and sold over a specific period, say a day or a week. It's not just numbers on a screen, it's a gauge of interest, liquidity, and potential price moves. High volume means lots of traders are in the game, which often signals stronger trends because there's more conviction behind the price action. Low volume. That's when things get sketchy. Prices can swing wildly on tiny trades, like a party with only a few drunk uncles showing up. Think about it this way. In traditional stocks, volume helps confirm if a breakout is legit or just noise. Crypto amps that up to 11 because it's 24/7 global chaos. From what we've seen in recent market recaps, volume isn't static. It's tied to everything from regulatory news to tech upgrades. For instance, when exchanges like Binance light up with activity, you see spikes that reflect broader sentiment. And right now, as crypto edges toward mainstream in places like sub-Saharan Africa with rising adoption, volume trends are shifting from speculative hype to more stable, utility-driven flows, especially with stablecoins gaining traction for everyday use. But why does this matter for you as a trader? Volume trends reveal the market's mood. Rising volume during an uptrend suggests bulls are charging in, while fading volume might mean the party's over. Tools like chart apps make this easy to spot. Candlesticks paired with volume bars show if that pump is backed by real action or just FOMO bots. We've got charts popping up everywhere these days, from mobile screens to laptops, helping folks analyze these patterns on the fly. It's like having a crystal ball, but one that actually works if you know how to read it. Diving deeper, one key trend shaping volume right now is the rise of Ethereum flipping the script on Bitcoin. After years of BTC dominating the volume game, ETH just broke a 7-year streak by surpassing Bitcoin's monthly trading volume. Picture this. Ethereum's network upgrades and the boom in DeFi and NFTs have drawn in hordes of traders, pushing its daily volumes to levels that make Bitcoin look like the sleepy giant it sometimes is. This isn't random. It's tied to Ethereum's scalability improvements, making transactions cheaper and faster, which juices up cross-trades and derivatives activity. What does that mean practically? If you're trading, watch for volume surges on ETH during altcoin seasons. High volume here often precedes price impacts, like rallies when Layer 2 solutions roll out. But it's not all smooth. Ethereum's gas fees can spike volume in weird ways, drawing arbitrage traders who exploit the volatility. Across the board, crypto derivatives markets are exploding, with volumes in futures and options reflecting bigger bets on trends. Valuation risks are real, though. Overleveraged positions can crash volumes overnight if sentiment flips. Speaking of sentiment, that's another layer. Tools like AI predictors are getting trendy for forecasting volume based on social buzz and on-chain data. It's not magic, but analyzing trader chatter can hint at incoming volume waves. For example, when adoption reports show stablecoin usage climbing in emerging markets, you see steady volume inflows that stabilize the ecosystem. But flip side, crime trends from recent analyses highlight how illicit volumes, think money laundering via mixers, can distort the picture, making clean trends harder to spot without digging into chain data. As we look at these graphs flickering by, it's clear volume isn't just about the coins, it's about the ecosystem. Bitcoin still anchors overall market volume, but altcoins like ETH are carving out bigger slices, especially in regions where crypto is becoming a lifeline for remittances. Planning your trades around these peaks? Smart move. Calendars marked with events like halvings or ETF approvals often align with volume booms. Shifting gears to how these trends play out in real trading strategies, let's talk drivers of volume spikes. First off, news and events are king. Guidelines can flood exchanges with volume as institutions pile in. We've seen this in year-end reviews where mainstream adoption pushed total crypto volume to new highs. But it's not always positive. Hacks or crackdowns trigger panic selling, inflating short-term volumes that fizzle fast. Take mobile trading apps. They're a game changer for volume accessibility. Anyone with a smartphone can jump into the fray, leading to broader participation and more consistent volumes outside traditional hours. This democratizes trends, but it also means retail-driven pumps can mislead if you're not checking the depth. Liquidity is crucial here. High volume with shallow order books is like a crowded elevator with no emergency exit. One big sell-off and everyone tumbles. Another driver, cross-chain trades. As bridges between blockchains mature, volume flows seamlessly between ecosystems, boosting overall activity. For 2025 and beyond, expect this to trend up with more interoperable protocols, making siloed volumes a thing of the past. But risks lurk. Valuation mismatches in derivatives can lead to cascading liquidations, wiping out volumes in a flash. Traders use volume to gauge these. If it's climbing on low-cap alts without fundamentals, that's your cue to tread light. Witty aside, these whiteboard sketches make it look like we're solving quantum physics, but really it's just arrows pointing to buy low, sell high with extra steps. Back to it, timing is everything. Weekly volume charts for Bitcoin show patterns tied to weekends, when Asian markets dominate, or midweek FOMC announcements that ripple globally. Spotting these helps you avoid fakeouts. For instance, a volume breakout without price follow-through often signals reversal. In practice, integrate volume with other indicators. Candlestick patterns on high volume confirm entries, while divergences, like price rising but volume dropping, scream caution. Apps for 2026 are already evolving with AI overlays, predicting volume based on historical trends and sentiment scores. It's empowering, but remember, past patterns don't guarantee future pumps, crypto's full of black swans. Now, onto emerging trends that could redefine volume in the coming years. Adoption is the big one, especially in underserved regions. Reports point to sub-Saharan Africa leading crypto uptake for payments, driving stable, recurring volumes that differ from the volatile swings we're used to. Stablecoins are the unsung heroes here, with usage reports showing them underpinning a chunk of daily trades, smoothing out wild fluctuations. But let's not sugarcoat. Crime trends are a shadow over this growth. Illicit activities like ransomware payouts still root through crypto, per recent analyses, inflating certain volumes and scaring off normies. Typologies are shifting too, more sophisticated laundering via DeFi, which muddies trend signals. For traders, this means using on-chain analytics to filter clean volume from shady flows. Tools are getting better at this, separating wheat from chaff. Looking ahead to 2026, expect derivatives and options to dominate volume shares, with risks tied to leverage. STech will push compliant platforms, potentially centralizing volumes but adding stability. Ethereum's edge might widen if it keeps outpacing Bitcoin, impacting prices as more capital rotates. Overall, two big trends define this: obvious mainstreaming via ETFs and apps, and the subtler shift to utility-driven volumes from speculation. Practical takeaway: layer volume analysis into your routine. Start with free chart apps to track 24-hour volumes across majors. Watch for crossovers, like ETH's recent win, and align with global events. It's not about timing the market perfectly, but riding the waves smarter. Wrapping this up, we've covered the essentials: trading volume as the market's pulse from basics to ETH's breakout, drivers like adoption and risks from crime, all pointing to a maturing scene. Trends show volume diversifying beyond Bitcoin, with stablecoins and mobile access fueling steady growth, while derivatives add spice and potential pitfalls. Key is using it to validate moves, not chase hype. So what's your take? Do you think Ethereum's volume surge signals the end of Bitcoin's solo era, or just a temporary flex? Drop your thoughts in the comments, smash that like if this clicked for you, subscribe for more crypto breakdowns without the boring lectures, and share this with your trading squad. They've probably got questions too. Stay savvy out there.